Really appreciate you all tuning in today. There have been many eye-catching headline news events happening, feels like every day, which in turn can impact the market and create short-term volatility. News events like the presidential election, Federal Reserve most likely cutting interest rates next week. Are they going to do 25 basis points, 50 basis points? What's inflation doing? Those are just to name a few. But in turn, we have seen volatility really pick up over the past month or so. On today's webinar, we have a very special guest with us. We have Elizabeth Muirhead from Vanguard, who will be sharing with us Vanguard's market outlook. Liz is the senior portfolio specialist at Vanguard, and she brings powerful insights into what's happening in both the market and the economy. And we do really appreciate her time here with us today. And Liz, to kick things off, we actually have had a lot of clients recently asking about the presidential election. Let's start there. This could easily be one of the most contentious elections we've experienced thus far. And I know the answer to this next question, but I think it would be good for you to share Vanguard's insights and maybe share more data behind some of the insights as to what the market's done historically during presidential election years.
Absolutely, Brandon. Well, I know when you're constantly engaged in this news cycle, it can be really worrisome to try to think about how some of these different outcomes might affect my investment portfolio, as you're saving for retirement, saving for your kids' college. And we definitely at Vanguard, we believe in having a long-term perspective. We think that the team at the Clark Group has put together really great portfolios for all of you that have taken into consideration your risk tolerance and your investment objective and your time horizon. And so you only want to deviate from that if one of those things changes. With that in mind, I do have some reassuring news for you. So let me just share my screen here, and I'm going to walk through some of the insights that we have on a historical analysis that we've done on politics, particularly presidential politics and investing. So we're going to start with just a very base level look at what actually happens to the stock market when one party is in power or another, and looking at the presidential election as a turning point that could create a shift in our investments. And I think what you'll see if you look at this chart is that when the market is going down, you'll notice a few key dates where that happened. So here in like 1974, 2001 into 2002, 2008, those are some pretty memorable time periods. In the case of the recent past, we have the bursting of the tech bubble, the defaults of Enron and WorldCom happening here. We have the global financial crisis beginning here. So these are, major market influences that have really nothing to do with which president is in power. And you can see that over the long term, the slope of the line is, that showing that the market goes up. And so what we concluded in looking at this is that, you really see the market going up regardless of which party is in power. And that is a very reassuring point. As you're putting your portfolios together, you're going to have some stock allocation, some bond allocation, but that stock portfolio is going to continue to go up over time with some blips from some of these exogenous events. Now, I want to take a step back and look at it not just with a stock-only portfolio, but with a balanced portfolio, because most of you probably don't have a 100% S&P 500 allocation. So here we're looking at the standard benchmark 60-40 portfolio, and we're saying, what happens to that portfolio in the different time periods where we had a Republican president or a Democratic president? And so you can see this busier chart here goes with a year-by-year look of each year during which a Republican or a Democrat was president. And you can see that over most years, those are positive returns. And there's not really a signal that says, ooh, all the times that that portfolio went down were one party or the other. It's really related to what was going on in the market that time. If we aggregate that data and look at it on a presidential term basis, again, you see even more positive confirmation that it's very, very unlikely that over a 4-year period, a balanced, diversified portfolio even experiences a negative return. And so we see that balanced portfolio, regardless of who's in power, tends to do a good job of managing risk and providing good risk-adjusted returns. So I do like to talk about, okay, well, what happens if you do hit the panic button, if you're really, really worried, maybe some of the news cycle has got you agitated. What people tend to do when they're really, really worried is they want to go to cash, because that to them feels like the safest investment that they can have. And so the problem with that is when you're market timing, you have to be right twice. You have to know when to sell to cash, and then you have to know when to get back in. And when we look at, what would happen if somebody just went to cash and waited out the election year, in many cases, that would be a bad decision for your wallet. There have been a few years where it would have done better for you, but that's not because of anything related to the presidential election. Again, 2008 was the global financial crisis. And so that's a completely different issue going on there. And even there, we started to see the market recover in 2009, and a lot of people missed that who went to cash during that period. And that's really the issue. When you look at the bottom line, somebody who stayed fully invested through all of these time periods would have significantly outperformed the returns from cash. So maybe I'm going to shift into just a slightly different lens on things. And this is maybe a little bit more to the point of what actually happens during a presidential term, because the president doesn't have a direct impact on the financial markets. And I think this also provides a good lens in terms of what the outcomes might look like. So first of all, we talk about the presidential election and the outcome as being very binary. It's either going to be, a Trump presidency or a Harris presidency. However, the reality is there's actually 4 possible outcomes. Okay, there's still one chief executive in all, in all 4 of those, but the outcomes are different. So you could end up on the Democratic side with Harris with a Democratic Congress. On the Republican side, you could end up with Trump with a Republican-controlled Congress. But in the middle, the purple scenarios are where you end up with Harris with a Republican Congress or Trump with a Democratic Congress. Those purple types of governments tend to provoke more compromise. They tend to slow down policymaking, and often they result in more thoughtful outcomes because compromises are generally good. What we see when we look at the impact of that on how many bills get passed is we see that, typically when there's one party in control, they tend to pass more legislation. And when it gets pulled back and we go from that to divided government, the number of policies, the number of bills enacted tends to fall. And so you see this, for instance, from 99 to 2001, you see this fall during a purple year, and then you see it spike back up. And then you see the same thing as we go through, 2 Democratic periods into, another purple era where the number of bills declines, rises up, and falls again. And so you see this pattern. So you really need to think about the election as having 4 possible outcomes. And in a purple outcome, there's going to be less policy making, less changes to how the economy is run. But what you'll notice here are the yellow dots. The yellow dots show you what the S&P 500 did in those terms. And what we show you at the top with the correlation is there's actually no relationship between what the S&P 500 did and how many bills were passed that year. So even though we do see this relationship between how many bills are passed in a divided government versus, a fully engaged mandate government, we don't see that translate over into investment portfolios. So I'm going to pause there. I do have a little bit more in this analysis, but it kind of goes to the what do you do with that question. So I can come back to it if we get to that.
And I think even going back to the chart that you just showed, Liz, I often tell, or we often, the advisors here at the Clark Group, tell clients that the market can take good news. It obviously likes good news, can even take bad news really well too, as long as it knows what the outcome is of that bad news. It just hates the unknown. It hates the uncertainty. COVID, as an example, when the global economy shut down, nobody knew the long-term impacts of what that would do to the economy. So the market declined. 2022, inflation spiked up. The Federal Reserve raised interest rates at the fastest pace that we've seen in decades, to the highest level we had seen in close to 2 decades. And in turn, the market didn't know what that could do to the economy. The market dropped. So with respect to this chart, what I think it highlights, and it's what we've discussed with clients, is when we're entering this election cycle and it gets very chaotic with headline news. And at the end of the day, headline news is there to scare people. It's there to bring in more viewership and get people more worked up. With mixed Congress, if let's say it goes in one direction or another for the president, but we have a divided Congress, there's less uncertainty, at least in our perspective, around what could happen with big legislative moves happening, big tax increases, or things of that nature. So even if one party, whoever's listening in right now, doesn't go the direction you'd like it to, let's look at what happens with Congress to really determine next steps. Not that that would change our investment portfolio or methodology, but it's something to at least have a conversation around. And I don't really want certain outcomes to worry people too much. So I think this chart is great. Now, maybe shifting gears here a bit, if there isn't much on the election that you have to show, anything else, that was super helpful, Liz. But with respect to the Federal Reserve and interest rates, that's another hot topic that we're hearing right now. So the Federal Reserve's meeting next week. There's been a lot of speculation around 25 basis points, 50 basis points. Would love to hear Vanguard's perspective around what you believe. You don't have to, I'm not going to hold you to it, but what you believe the Federal Reserve will likely do with interest rate moves and how that could also impact certain asset classes moving forward. So it's kind of a two-part question. Interest rate moves, what do you think could happen there, as well as if interest rates do go down, the impact to certain asset classes?
Sure. So I'm going to take a little bit of a measured approach to this question. First of all, I want to say that predicting what the Fed is going to do is always difficult, because one of my favorite things to say is even the Fed doesn't know what the Fed is going to do. And so those of us who sit here and pontificate on it need to, have a bit of humility in mind as we do that.
You remember the days where they used to have a briefcase and look at the briefcase from the Fed to determine what the Fed was going to do next? So there's always going to be that speculation around interest rate moves.
Exactly. But I think we've gotten a pretty clear message from Chairman Powell at this point. It's not a matter of will they cut, but it's really a matter of how much.
Right.
And when we look at some of the data, what we've noticed is that up until July, the Fed had really been singularly focused on defeating inflation. And now we're in an environment where inflation has come down enough and moderated enough. It's still not to their goal. They still have a little ways to go, but it's moderated enough that the Fed is feeling more confident holding their two goals in tandem with one another. And they have two goals, really. They have what we describe as a dual mandate. One of them is to manage inflation. But the second one is to help stimulate the economy, help GDP growth, help unemployment be low. And they've now been able to make a shift where they're no longer singularly focused on inflation, but they're also paying attention to the other side of that dual mandate and looking at the labor market and looking at the growth level of the US economy. And what we see when we look there is we don't see anything alarming, right? We don't see some big, huge, 2008 level recession lurking over the horizon. But we do see that US growth is cooling. So we see labor markets are coming into better balance, but they're still pretty healthy relative to historical norms. We've had a really high level of consumer demand that has started to taper back off. And it was almost a recovery from COVID when all of us stayed in our houses and we didn't spend any money except via Amazon, right? But we had a lot of pent up demand for travel, for leisure, for entertainment, for going out and living our lives. And that started to work its way through the economy. And because of inflation and because we've worked some of our savings back out into the world, many people are being a little bit more conservative in their spending. So we've seen that slow down. We've also had, a bit of a cyclical productivity boost because we had, some distortion in productivity from COVID. That that catching back up environment has kind of worked its way back through the market. And so those different factors mean the economy is slowing, but it's nothing to be seriously alarmed about. But what that does mean is that the Fed can look at where their interest rate policy is today and say, we might be too restrictive for how much farther we need to get on inflation and for how much this is impacting the economy. And so, we think that right now it's a little bit of a, coin flip as to whether they do 25 or 50 basis points. Our house view is 25 basis points. We think they're going to be cautious with that first cut and just make sure everything's good. And then we think they'll do another 25 basis point cut before the end of the year, probably in December. So that's our view. We think that they'll then continue to cut into 2025, and they'll do another 150 basis points in 2025. And so we think when we get to the end of next year, we're going to have the monetary policy rate at around 3.5%. So that's about where we think it's going. We think they're going to start with a 25 basis point cut, but even if they start a little bit more aggressive, we still think that's kind of the timeline over which they reach a stopping and reassessment point.
That makes sense. Now, is the reason why Vanguard believes 3.5% on the Fed's fund rate is because inflation is around 2.5% right now? There's a correlation. So for those listening in, there's a correlation between the Fed funds rate, meaning interest rates, and inflation. We all know that. But the Fed's objective is to get the federal funds rate close to in line with inflation. So right now we're at 5.5. Inflation just came in at 2.5. So there's significant decreases that should come into place if inflation stays around its current levels. So that 3.5% number that you had just thrown out, Liz, is it because it provides some wiggle room for the Fed to not get too loose with monetary policy where they're now behind the curve again and inflation starts to spike up? And that's why there's a little bit of a gap, or is there something else at hand?
There's something else at hand, Brandon.
Okay.
And this is maybe getting a little bit weedy into economics, so hopefully your clients will bear with me. But there's something called the neutral rate. And the neutral rate is the Fed funds rate at which the economy is at equilibrium. It means that the rate is not dovish or hawkish. It's not stimulative or restrictive. It's basically the rate that they could leave it at and they would have no impact on the economy at all. Our view is that that neutral rate has actually moved higher than it was in the post-global financial crisis era. If we go back to before the global financial crisis, the neutral rate was higher than 50, to higher than 50 to 250 basis points, right? So it was a higher range, but during that post GFC period, we had very, very low rates. We had very, very low inflation. We had, really strong labor force. All of these factors were working in our favor in terms of economic growth. And unfortunately, some of that has shifted today. When we look at what affects the long-term view of what's going to happen in the economy, we see a few things that are causing the neutral rate to move higher. So one of them is we are seeing demographic shifts. And this is probably not a shock to your client base, but the boomers are retiring. And the boomer generation is larger than my generation, Generation X, and the generation that comes after me, the millennials. And so you end up with this drain on economic productivity when you have more of your population drawing down on their investments instead of adding to their investments. And so it's kind of like a math problem right there. We saw this, in the 80s into the 90s. We saw a similar demographic shift happening then, and we're just seeing it continue to a greater extent today. The other thing that's happening is, we have had significant and rising deficits from our government spending. And although deficit spending is not, a horrible thing, when deficits get significantly large, they can start to drain the economic productivity. What we've seen that when deficits grow to about 100% of gross domestic product, GDP, we start to see them have an effect that slows down economic growth. When we look at how our deficit has been growing, our annual deficit from the federal government is growing at a greater rate than GDP. The long-term trend run rate of GDP is about 2%. And what we've seen from economic growth is pretty supportive of it returning to that trend growth rate. But the deficit itself has been growing at least double that, and even in some conservative projections of what either election outcome might lead to in terms of deficit spending, neither presidential candidate seems very interested in reducing the deficit. It's really just a question of how much more debt will their policies add.
Right. It wasn't mentioned once during the debate the other night, which, in my opinion, it's one of the, if not the most important topic right now.
It's a topic I hear about a lot from advisors and their clients. I think, citizens are worried about this much more than politicians. But the problem is that the solutions aren't easy. You really can't solve the problem with just one set of policies. If you're on the right side of the aisle, you want to solve it with cutting discretionary spending. And if you're on the left side of the aisle, you want to solve it by raising taxes. And the reality is, I remember, I think it was in like the early 2000s, there was a calculator on one of the big New York publication websites where you could try to solve the deficit problem yourself. And even then, if you just moved the slider only towards tax or only towards spending, you couldn't solve it. And imagine today how much more challenging that would be. It really has to be a multi-factor approach. And we don't really have the political environment in Washington for that right now.
Yeah, certainly. And shifting gears a bit back towards what the Federal Reserve's doing, unemployment, interest rates, you could make the argument in a sense that what they've done with raising interest rates to the current level is working, even though unemployment's starting to trend higher. It was inevitable that unemployment would start to creep up a bit from going from 0 to 5.5%. Not to mention GDP is still growing. So that's a positive.
It's just
But
growing at a slower
it's
rate.
going at a slower rate, which we all knew would happen if you raise interest rates that high. So now they're going to start cutting rates. They don't want to be too late like they were previously with raising rates. So in turn, with your cash, with your money market funds, CDs, stable value funds that were earning you 5.5%, 5.25% 6 months ago, in 6 months from now, that most likely will not be the case.
I
So
mean, it's
it's already
already,
dropped dramatically. Exactly. It's already in the four range. I mean, it depends on what exactly you're looking at. If you look at 3-month treasury bill, it's sub 5%. So imagine all the way out to 20, 30 years, even though the curve is starting to normalize, the yield curve from being super inverted to now starting to go more in that normal trend, bottom left to top right. But what we started doing several months back with anticipation of the inflation trend steadily coming down and interest rates most likely coming down from here, we started to go a bit further out with duration with bonds to lock in that interest rate for a longer period of time. Now, we're not going too long on the yield curve because it typically doesn't make sense for our clients from a risk return
sure.
trade-off, but would love to hear your perspective on what would make the most sense, or Vanguard's perspective. We know long duration asset classes like stocks tend to do well when interest rates come down, long-term bonds. What's Vanguard's perspective with certain asset classes that you think are more favorable?
Sure. Well, the first thing I'm going to say is get yourself out of cash if you haven't gotten out of there already. The biggest risk for 2024 is interest rate risk, right?
Right, exactly.
Your reinvestment risk, whatever you're earning right now on a sub 6 month or even sub 1 year investment, like that's going to be gone
Right,
in a week or two, if
right.
not more.
Yeah,
And
and
so
just to make note, that interest rate risk, it's so important because in 2022, there was interest rate risk on one side where interest rates spiked up. So you had interest rate risk on long-term bonds and long duration assets. And now we're on the flip side of that, where there's interest rate risk on shorter term vehicles, investment vehicles.
I want to break that down into just some numbers for your clients.
Please.
So if we were sitting here in 2021 and we looked at, what's the likelihood of different scenarios with bond investment? You were sitting in a place where the average bond price was, at a premium to par. So let's say 100, 105, 110% of the maturity value. Rates were at historical lows. And so the most likely scenario is that rates were going to go up and price losses were going to be significant. And in fact, if I put some numbers behind that, there was a 60% chance that rates would go up and price losses would be greater than the income that you get, and only a 25% chance that rates would fall and you'd have positive returns. And there's, like a 15% bracket in the middle where it's like not much would happen. Now, that means that your risk was skewed asymmetrically to the downside. And that's caused a lot of people to look at what happened to them in 2022 and say, oh, I don't want to be in bonds. But let's look at where we are today. Today, and in fact, if you go back a month, this looked even better. But today, bond prices are typically below par. So let's say 95% of their maturity value. So even if nothing happens with rates, they're going to move towards their maturity value over time. But rates are above the level that we know the Fed eventually wants to take them down to. And if you pretty much ask anybody, while we may have differences of opinion in what the Fed's going to do with rates this month or this year or next year, I think most people would agree that 2 years from now, rates will be lower than they are today. And so if you're in an environment where rates are higher than they're going to be in the future and bond prices are below their maturity values, your risk is skewed asymmetrically to the upside, which is the exact opposite of where we were 2 years ago. And let me quantify that for you. There's a 50% chance that rates are going to fall and there will be positive returns, and only 11% chance that rates rise and price losses are greater than income return. That middle section, about 30 8% is a situation where rates rise, but you're getting so much income that actually offsets the price losses. And so now you have kind of an 80% skew in plus in your favor in terms of bond returns. So even if something that nobody foresees happen and rates go up, you're starting with enough of a yield cushion that you're still going to have net positive returns. And so that creates a really great level of synergies for investing in bonds. Now, what does that mean in terms of your portfolio? You asked me where do I see people position along the curve? First of all, it's always client specific. You need to think about your client's time horizon and risk tolerance. But for most clients, we think that an intermediate term duration is a great starting point. And that typically puts them between 5 and 7 year duration. So the middle part of the curve, intermediate term duration, similar to the duration of the broad bond market. And with that duration, they're going to get a nice durable yield. So you'll be able to get in those yields and have those higher than long-term yields for a long period of time. But you're also going to be able to participate in some price appreciation. Now, if you know bond math, you might wonder, hey, Liz, if you think rates are going down, why wouldn't you want to be at the 10-year part of the curve or the 20-year part of the curve or even the 30-year part of the curve? Because aren't you going to get the biggest bang for your buck there? And my answer is not quite. There's a couple of different reasons why that approach worries me. So first of all, when you're investing in bonds, time and bond math can always be on your side. If you keep the duration of your fixed income, your bond portfolio, inside your time horizon, if something unexpected happens with rates, as long as you hold that portfolio through the duration, that bond math is going to work out in your favor. So if you had an intermediate term duration bond portfolio in 2021, although it may have lost money in 2022, because you were able to compound your higher yields, reinvesting them in that portfolio, by the time you get to 5 or 6 years holding that portfolio, you're now better off than you were in 2021 in terms of your long-term returns. And that is a really powerful thing. So if your time horizon is 20 years, I guess you could invest at the long end of the curve, but I don't know that you want to have the risk tolerance or the patience to wait out the market moving unexpectedly. But there's an even better reason why I'm cautious about the long end of the curve. And this is because what we see, particularly in the taxable market, where we've got the US Treasury as kind of the bond of choice, we see a lot of demand coming from outside entities. And when we look at the buyer base for bonds at the long end of the yield curve, we've seen a shift. So we know that the government keeps increasing its debt, and there's been some concern about demand for the bonds that they issue, but the demand has been there. However, the demand is coming from different buyers. So if you go back a few years, the Federal Reserve was buying a lot of treasury bonds. Banks were buying a lot of treasury bonds. And overseas investors from Japan and China were buying a lot of treasury bonds. If we look at today, again, that demand is still there, but the buyers are skewing more towards households. So people like you buying them on behalf of your clients, hedge fund managers, and investment managers like our folks here at Vanguard. And those investors are motivated by value. You care what you pay for these bonds. When the Federal Reserve is buying them, I'm going to tell you, they don't care about value. They really do not.
Right.
They're going to buy them at any place, any price, just sweep them in, sweep the bonds into the portfolio. And right now they're net sellers of bonds. So we're not seeing them in the market. Banks still are price motivated, but they're typically thinking about trying to match their assets and liabilities. And so they might find bonds attractive that other buyers might not. We've seen banks slow down on their bond purchases following Silicon Valley Bank as they await a more stable interest rate regime and perhaps even some new legislation on that matter. And then foreign buyers are very much driven by relative currency levels. And if we look at the cost for them in their local currency versus buying homegrown bonds, we've seen a real shift that have made homegrown bonds in China and Japan relatively more attractive for those investors. And so when we look at the long end of the curve, even as the Fed brings rates down, we might see the long end of the curve react accordingly, but we could also see the long end of the curve stay the same or go up. And that's just such a high level of risk for clients that I'm not really comfortable having somebody step outside their time horizon, knowing that it might not go the way that they like.
Right. Yeah, that's extremely helpful. And I think it all comes down to your specific financial plan. Let's make sure you have enough in cash reserves. You have enough set aside as a rainy day fund that still can earn you in the meantime a very competitive rate. And then let's figure out your investment portfolio, how much risk you can tolerate, how much you need to pull off of that portfolio based on other income streams like Social Security, pension, rental. And then from there, we design a portfolio, just like for all of our clients, to make sure that that fits their specific goals. And we have certain objectives within each of our equity and fixed income buckets for your risk tolerance and goals. And then we update that. We make sure that your financial situation is aligned with your portfolio at all times. And if something changes, then in turn, we may need to make a change to the portfolio. Moving towards the equity markets a bit, that was very, very insightful for bonds. We've seen such a massive run up in the equity markets, a lot to do with artificial intelligence. Now that's starting to simmer off a bit. You see the semiconductor space, which names like NVIDIA, Broadcom, they have the most skin in the game, so to speak, with artificial intelligence. But the equity markets have seen such a big run up. Does Vanguard see that narrative shifting? Because there's a lot of comparison right now between the tech bubble in 2000 and what we're seeing right now. I think it's completely different if you look at technology names. Names like Apple and Google and Amazon are so well diversified and are in so many different facets outside of just traditional tech versus names like Cisco and IBM in 2000, which were very one-dimensional. Do you see that AI narrative cooling off here in the near term and maybe picking back up at some point? Because I do think the long-term narrative is there, but a lot of that positivity has been priced in already, which is a little concerning. So what are your thoughts there?
Well, I'm going to show you two graphics. So one is showing valuations of the S&P index going all the way back to where the tech bubble was. And one of the things that you'll notice is that the valuations, especially before the most recent pullback, actually came as close to the period before the bursting of the tech bubble as we've seen since that time. So pretty strong valuations relative to history. Now, I say that, but I'm going to caveat it. In the tech bubble, a lot of those run-ups were based on, the internet revolution and being able to derive revenue and value out of clicks and eyeballs, as opposed to earnings and sales. And so I think when we look at those companies, many of them had very little capital on their balance sheet. They were capital light companies. There wasn't a lot really to sustain those valuations. When we look at the most recent periods and some of these companies like Microsoft, Apple, NVIDIA, there's actually a lot to them. There's recurring revenue streams, there's capital equipment, there's investments that they've made, and the promise there is much more significant. So I don't expect the type of cratering in valuation that we saw with the bursting of the tech bubble, because these valuations are actually justified to a much greater degree than those were. But what's been priced in is almost like a best case scenario of AI growth. And I'm going to show you kind of our view on what could happen with AI. So our base case, our view is that AI is transformational, that AI is going to emerge as a very significant technology that's going to allow productivity to surge in a way that exceeds the tailwinds that we got from the invention of the personal computer or the internet. And so that's where we've put our stake in the ground. We could be wrong, right? So there's a downside case that you can see here on the page is, 30 to 40% that AI fails and deficits dominate, or 10 to 20% that, it doesn't really change anything. So even though AI being transformational is our base case, we could be wrong. So that's the first thing. And then the second thing is it's important to understand how transformational technology actually works and how it impacts the economy. What we typically see is you start off with several years where the companies that are generating this technology make huge upfront investments without really being able to yet benefit from the economic impact in terms of productivity growth and earnings. And so what that does is it actually suppresses their earnings and it suppresses their growth at the beginning. We call this a J curve, because if you take the letter J and you kind of lay it on its side, you might think of it also as a hockey stick. You see this decline the first few years, and then all of a sudden, whoo, it starts to increase exponentially. That entire process usually takes about 10 years, and we are very early innings. So we think the market has gotten ahead of itself in pricing in the success of AI, both in terms of probabilities as well as the time. So we do think AI will be transformative. We do think it will be transformational, but we don't think those valuations are justified right now. What we do think, though, is that when it does happen, it's not just companies like NVIDIA, Microsoft, and Apple that are going to benefit. Right now, those are the only companies that are priced to benefit from AI. We think that those benefits are going to translate and ripple across the markets. It's going to change the way dozens of companies work and operate and allow them to invest in technology that boosts productivity in a way that allows them to adapt, run more efficiently, produce more output, not necessarily by cutting jobs, but by allowing individuals who are their employees to do things that are uniquely human and benefit from the greater span of insight that AI allows them to have. Now, what does that look like? That looks like small cap companies benefiting. That looks like value companies benefiting, and even non-US companies benefiting. So right now, all of that success, potential success of AI is concentrated in US large cap growth companies, specifically technology companies. And we think the impact's going to be a lot broader than that.
So if I'm hearing you correctly, you think it's going to spread out across other stocks, other companies outside of the Magnificent Seven, names like NVIDIA, Tesla, Apple, Microsoft, and a few
I mean,
others.
how many of us today use personal computers and the internet in our
Right.
jobs?
Exactly.
Everyone.
Right.
And that's the point.
Exactly. Yeah, that's really well said. And I think we're coming up on time here, Liz. So if there's anything else that you thought would be helpful to share with our clients, would love for you to do so. Otherwise, we can jump to a Q&A segment.
Well, I think one thing that I like to bring up, because it's a constant question or area of pushback that comes from clients to their advisors, is about diversification in your portfolio. It's very tempting to look at the different components of your portfolio or the different components of the stock market and say, this is what's been working, and so I want more of this and less of everything else. The problem is that diversification is there because we don't know in advance which part of the market is going to outperform. I mean, absolutely, there are things that we can be sensitive to or alert to, like right now, as we enter an environment where we think the economy is going to slow. It makes sense to position your portfolio slightly more defensively in order to prepare yourself for that. But when you're thinking about the long-term allocations that you have, we find that a lot of client portfolios are underweight international equities, and a lot of clients would like to stay that way. And so a couple of things that I would say, first of all, remember that just because you have some of the best companies in the world in the US, you're actually very concentrated in some of those sectors. So the US is a very technology heavy economy. If you go outside the US, you get a lot more exposure to financials and energy. And so going outside the US allows your sector allocation to be more diversified. But there's also sometimes a benefit in just individual stock diversification. And one of the examples that I love using for this, and I've shared with a lot of advisors, is just thinking about individual industries. You might look at, a particular company and you say, well, this company sells globally, so I really kind of have non-US exposure because they're selling, in Europe and Japan and et cetera. So I'm going to give you an example. Let's say that you want to be exposed to companies in the air cap equipment industry. This is, essentially a duopoly. There's two main companies that do all of the sales in this industry. If you've ever flown on a plane, you're pretty much flying on one plane or another. So the US company is Boeing, and the non-US company is Airbus. I'm sure many of us have been on Boeing planes and many of us have been on Airbus planes.
A
But if
lot of
you're
our clients
only,
listening in work at Boeing.
oh
So
yeah,
yeah,
so does my nephew.
yeah,
Yeah. So if you're only holding a US portfolio, you only have exposure to Boeing. But if you're holding a globally diversified portfolio that includes US and non-US, you also have Airbus. And so that gives you that exposure. Boeing hit a snag this year. Their stock price went down significantly. That was a company specific issue that Airbus didn't experience. So somebody with a globally diversified portfolio did better than someone with a US only portfolio in that particular sector. So that was something that I think is helpful to keep in mind. And just remember, diversification, it's like your insurance, right? It's there because you don't know in advance when you're going to need it.
very true. I mean, at the end of the day, when you're designing portfolios, risk management has to be at the forefront of what you're
Mhm.
doing. So there will be times where it doesn't feel like certain asset classes and positions are working, but in reality, they are working, because if other positions are zigging while that one zags, so to speak, it means that it's doing its job in the meantime. And then there will be another period where the positions that are working won't work, and the ones that weren't working start to make a turn. And then even within our portfolios, just like diversifying asset classes, you want to diversify strategies too. You want to be able to be dynamic with respect to what's happening in market conditions. So I'll leave it at that, because again, we are coming up on time, but that was extremely helpful, Liz. Really appreciate all the insight that you've instilled in our clients. It was invaluable insights, not only from Vanguard's perspective, but you being able to articulate what's happening in the market and the economy. It was well said. So thank you again for speaking to our clients, and hope to see you soon.
Thank you. Thank you for having me. And we're happy to be here and support you all. We treasure our partnership with Clark Group. So
Absolutely.
glad to be
Likewise.
here.
Likewise, Liz. Thanks so much. Take care.
Thank you.
Bye bye.